NVIDIA Corporation is trading at $180.27 as of early afternoon on Wednesday, January 21, 2026, marking a gain of $2.20 or 1.24% in active intraday trading. We're watching the stock bounce back from an earlier low of $178.40, showing significant resilience even as the broader tech sector faces some choppy waters. Most people looking at their screens right now see a company that has already won the hardware race, assuming the heavy lifting is done and we are just waiting for the rest of the market to catch up. The expectation is that after years of triple-digit growth, we should be seeing a tapering off, a steady glide path into a more mature, slower growth phase. But the reality is actually much more aggressive. While you might hear whispers of a cooling market on your favorite investing sites or through various investment help forums, the internal numbers tell a story of a company that is essentially rebuilding the entire global computing infrastructure from the ground up. The most startling bit of data isn't just the revenue, it's the sheer scale of the backlog. We're looking at a pipeline that recently exceeded $500 billion, driven not just by the usual hyperscalers, but by a massive shift in how sovereign nations are treating compute power. This isn't just about selling chips anymore. It's about the fact that compute has become a form of national currency. When you look at your individual brokerage account, whether you're using the Fidelity mobile app or checking your positions on the Robinhood app, it is easy to get caught up in the daily price swings. Today's volume is tracking close to 100 million shares, which is a healthy clip, but the real story is in the institutional activity happening behind the curtain. We're seeing a massive rotation of capital where large-scale funds are moving out of traditional legacy tech and doubling down on NVIDIA stock because it remains the only clear way to play the physical layer of the intelligence build-out. There is a common belief that the competition from custom silicon, chips designed in-house by the big cloud providers, is going to eat into these margins. However, if you look at the recent partnership with Anthropic for the upcoming Vera Rubin architecture, it becomes clear that even the most sophisticated AI labs are choosing to lock themselves into the NVIDIA ecosystem for years to come. This is the curiosity loop that keeps professional traders engaged. How can a company with a multi-trillion-dollar market cap still have a PEG ratio that looks more like a small-cap growth play? The answer lies in the 75% gross margins that the company is maintaining even as it scales. For those of you managing a self-investing strategy, perhaps through SoFi Active Investing or an Interactive Brokers account, you've likely noticed that the semiconductor sector has become the primary driver of the S&P 500's direction. When NVIDIA stock moves, the entire market feels the vibration. Today's movement is a perfect example of the tension between expectation and reality. The market expected a period of digestion after the Blackwell launch, yet we are seeing a massive uptick in demand for sovereign AI clouds. This is a development many retail investors missed. Countries like Saudi Arabia and various European nations are now building their own domestic AI factories to ensure data sovereignty, and they aren't looking for budget alternatives. They're buying the best possible hardware to ensure they aren't left behind. This creates a floor for the stock price that few analysts were pricing in 18 months ago. If you are using a robo-advisor like the SoFi robo-advisor or Schwab Intelligent Portfolios, you're likely seeing a steady weighting in these large-cap tech leaders because they have become the new defensive plays of the digital age. The sheer volume of capital flowing through the Interactive Brokers platform and similar professional-grade tools suggests that the smart money is not exiting, they are repositioning for the next product cycle. We often talk about these companies in a vacuum, but the interconnectedness is vital. For instance, the demand for power infrastructure to support these data centers is hitting record levels, which in turn fuels the need for more efficient chips. This is where NVIDIA's shift toward integrated systems, not just individual components, really starts to pay off. They are no longer just a chipmaker, they are a data center architect. This transition is what separates the reality of their business model from the expectation that they are just another hardware vendor subject to the typical cyclicality of the chip industry. When you are the one setting the standard for the entire industry's operating system, you aren't just a part of the cycle, you are the one driving it. I want to take a second to hear from you. Comment below with how many shares of the NVIDIA stock you are currently holding, or if you prefer to play the sector through something like Fidelity ETFs. It's always interesting to see how different people are structuring their portfolios in this environment. Are you a long-term holder, or are you actively trading the volatility we've seen over the last few sessions? The technical setup on the NASDAQ NVDA chart today is showing a fascinating consolidation pattern. We're seeing a cluster of moving averages around the $183 level, and the fact that we are hovering just below that suggests a coiled spring effect. Short-term traders using the Fidelity trading platform or Robinhood stock trading features are watching for a definitive break above that $185 resistance zone to confirm the next leg up. Meanwhile, the downside support at $178 has held firm through 3 separate tests in the last 48 hours. This tells us that there is a significant buy-the-dip mentality among institutional buyers. They aren't waiting for a massive correction, they're nibbling every time the stock takes a breath. This activity is backed by the fact that the company's free cash flow is projected to hit nearly $500 billion over the next 3 years. To put that in perspective, that is more cash than most countries have in their entire treasury. Looking at the broader landscape of online investing, the accessibility of fractional shares through the Robinhood app or SoFi Invest has changed the way retail liquidity enters these high-priced names. Even at $180, a full share might seem steep for a new investor, but the constant inflow of small dollar capital creates a persistent tailwind. This is a different market than the one we saw a decade ago. The expectation was that high valuations would eventually scare off the retail crowd, but the reality is that the brand power of these tech giants has created a loyal base of individual brokerage holders who see these names as the Goldman Sachs of the new century. They are not just stocks, they are core holdings that people intend to pass down. This emotional and structural floor is something that traditional valuation models often struggle to account for. To understand where we are going, we have to look at what this company actually does at its core. Beyond the ticker symbol, NVIDIA is the primary provider of the brains for the modern world. Their graphics processing units, or GPUs, were originally designed to render video games, but the realization that these chips could perform thousands of small calculations simultaneously changed everything. Their software layer, CUDA, is perhaps the most undervalued part of the business. It is a massive moat because once a developer learns to build on NVIDIA's software, switching to a competitor like AMD isn't just a hardware change, it's a total rewrite of their entire code base. This is why when you look at investing sites for investment help, you see such a heavy emphasis on the ecosystem rather than just the hardware specs. The company's business model has shifted from selling a product to selling a solution. They now offer everything from the networking gear, thanks to their acquisition of Mellanox years ago, to the cooling systems and the software that manages the entire stack. This makes them a one-stop shop for any enterprise or government looking to enter the space. If you are using Fidelity Wealth Management or a specialized Fidelity brokerage account, your advisor is likely highlighting this diversification. They aren't just dependent on one industry. While gaming was their roots and data centers are their present, the automotive and robotics sectors are the sleeper hits in their portfolio. Their drive platform is being integrated into the next generation of autonomous vehicles, creating a recurring revenue stream that will persist long after the initial chip sale. This is a massive shift from the one-and-done sales model of the past. As we look toward the future, the outlook is framed by the upcoming transition to the Rubin architecture in late 2026. The expectation is that Blackwell will provide a steady stream of revenue through this year, but the reality is that many customers are already looking ahead, trying to secure their place in line for the next big jump in performance. This creates a perpetual cycle of demand that keeps the growth rate elevated. The risk, of course, is macroeconomic. Rising interest rates or geopolitical tensions can always throw a wrench in the works, especially given the complex supply chains involved. However, the company has been aggressively diversifying its manufacturing base, working with partners to build facilities in the US and Europe to mitigate these risks. This proactive approach is another reason why